Hello everyone, I'm Cici Chen. Welcome to Investing Financial Forum. In this video, we will share the most recent market updates on finance and investment. Although we are not able to provide you personal financial advice, we hope you find it helpful for your own financial arrangement. In the last episode, we got some general ideas about mortgage fund investments. Today, we are going to take a further look at contributory mortgage fund. Hi JT, to continue our last topic, can you please tell us a bit more about contributory mortgage fund?
Hi CC, it's great to be here again. I mentioned last time there were two types of funds, the pool fund and the contributory. The contributory today is much more popular, so it's good we're talking about that. Contributory fund is where the investment manager will find a good mortgage investment and then the manager will offer that to investors. So investors, if you like, will have a smorgasbord of assets to choose from, and they can choose to invest in a number of them or in one of them. But it doesn't matter how many they invest in, each asset is a separate investment. So if they invest in the first one offered by the manager, they may invest by themselves, but often with two or three other investors. And so their money is directly invested in that asset, which is a property, and the money is lent to a borrower for their business purposes.
Right. So from the investor's perspective, managing risk, in other words, not losing the principal, is a number one priority. So how do you normally assess the loan?
It's a very good question, CC, because when investors put money with you, they want it back. So when you're talking about mortgage investment, the first thing is we need to look at what we call the character of the borrower. If that borrower is a good person, if the company's good, if they haven't had any previous experience of mortgage default or not paying bills, then we would consider them of good character. If they have a very checkered record of borrowing money, we would probably say no.
Of course.
The next thing we look at is what we call their whole capacity to pay the interest on the loan and to pay back the principal on maturity. So if it's a business, we look at what we call their historical cash flow, how they've gone over the past 2 years. We look at their financial accounts. And we'd also forward look and say, can you give us a financial projection of how the business will go in the future? People understand that more today because in the COVID environment, what somebody did in the past is not going to pay the future bills. So cash flow is important. Lastly, and I say lastly, we take a mortgage over a good property. You should never look at the property first because it means that you're not going to be very good at the credit assessment. So we make sure the property is a saleable property, it's in a good area such as Sydney and Melbourne, and we make sure that we only lend no more than normally 65% of the value of that property.
So how do you determine the value of the security that we take as mortgage?
It's a very good question, CC, and investors will be comforted to know that under the rules that we operate in Australia, a mortgage fund manager must ask a registered property valuer to go out to inspect the property and to make a whole lot of inquiries, including what we call comparable sales, and then come back and say to the manager, we certify that this property is worth a certain amount of money. A good investment manager will actually go out and make their own inquiries and check it. So that is really important because if you don't do that, and if a borrower should default, perhaps the value that you thought the property was going to achieve won't materialise. So it's a really important consideration.
Okay, so what if in the event of default, how do you recover the debt to protect investors' capital?
It's an interesting question, CC, and I guess in my career I've had a lot of experience with this. The first thing is if a borrower defaults, hopefully you can talk to them and work out a repayment plan so that they rehabilitate their arrears over a short period of time. But I understand the nature of your question. You're actually saying if the borrower cannot make any payments, how does the investor get their money back? In Australia, there is a legal process that we go through, and we ultimately ask the court to make a determination to award us what's called possession of the property. And once that happens, we will go and put that property on the market just as somebody would put their property on the market. And when it sells, we then recover the amount that's owed to the investors, and then the borrower or anybody else that might have a mortgage will be paid out of that surplus.
Right. So based on what we discussed today, I believe by investing in the contributory mortgage fund, investors not only enjoy the stable income stream, but also the capital preservation, and they also have the opportunity to choose the borrower and the loan that they like, right? And I think it's a very excellent investment options that can be part of the balanced investment portfolio.
Absolutely, CC, and I couldn't have put it better myself. Thank you.
Thank you. Thank you very much.
Pleasure.
Hope you enjoyed the topic today, and thank you for watching. If you have any questions or opinions, please do not hesitate to contact us by email. Welcome to subscribe our channel and give us a like if you think this video is helpful. I'll see you next time.